Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. I think the first thing people really need to understand about energy fuels is that it's not just a uranium play anymore.
Right. For years, that's all you heard. Energy fuels, uranium. Simple as that.
Exactly. But they're pushing a very deliberate diversification strategy now. It's really built on three pillars. Uranium, of course, but also rare earth elements, or REEs, and heavy mineral sands.
So they're building a whole critical minerals platform.
That's the goal, to get away from that, that boom-bust cycle of just one commodity.
And the key to this whole thing, the asset that makes it all possible, is a White Mesa mill in Utah.
It's their moat. I mean, it is their entire competitive advantage, really.
Why is it so important?
Well, because it's the only conventional uranium mill operating in the entire United States. The only one.
So the regulatory barrier to entry is just massive. No one's going to get a permit to build another one of these anytime soon.
Not a chance. And the really smart move is how they're leveraging it. It's not just for uranium anymore. It's become the hub for their entire rare earth separation strategy.
They've turned a single-use asset into a multi-commodity platform.
Precisely.
Yeah.
And that's what's accelerating this whole pivot.
Okay, but let's not get ahead of ourselves. The original business, uranium, is still the engine driving the cash flow right now, and the market for it is, well, it's pretty hot.
Oh, it's fantastic. The tailwinds are huge. You're seeing spot prices holding strong around, what, $82.50 a pound? And the long-term price is even higher, up near $86. That shows you utilities are really committed. They're locking in supply for the long haul.
So how's the company responding on the production side? Are they ramping up?
They are. Management's already signaling that they're on track to beat their 2025 production guidance. So you have higher volumes hitting a very, very strong price environment.
Okay, that's where the story gets really interesting, right? The margins. Because a high price is one thing, but what does it cost them to produce it?
This is the key that unlocks the whole thing. Their weighted average cost for their finished uranium inventory it's surprisingly low, around $53 a pound.
So even right now, they have a $30 margin per pound. That's solid.
It's very solid. But it gets better. They're projecting that costs will drop even further.
How low?
Potentially into the $30 to $40 a pound range by early 2026.
Wait, so you're telling me they could be producing for, say, $35 and selling for $85?
That's the projection. A $50 per pound cash margin.
Wow. That is a massive gross margin expansion, and that's the cash that funds this whole big pivot we've been talking about.
That's it, exactly. That potential windfall from uranium gives them the runway and the market confidence to go after what we're calling the real game changer here.
The rare earths.
The rare earths breakthrough.
All right, let's jump into that, because this is why the stock has seen so much attention lately. What did they actually achieve?
So the big news was they successfully produced dysprosium oxide at pilot scale with 99.9% purity.
Okay, break that down for us. What is dysprosium, and why does 99.9% purity matter?
Dysprosium is a heavy rare earth element. It's absolutely critical for high-performance permanent magnets, the kind you need in EV motors and wind turbines.
And the purity, is that hard to do?
It's the gold standard.
Okay.
It's incredibly difficult technically. Separating these elements is a nightmare. So hitting that 99.9% number proves their process at White Mesa actually works. It's not a theory anymore.
And they've already got a customer to prove it, right?
They do. A major South Korean auto manufacturer has already qualified the material for use in their permanent magnets.
That's huge. It's not just a lab result, it's a commercial product.
Exactly. It connects the technical win directly to a real high-value market. And that's before you even get into the geopolitics of it all.
Ah, right. The non-Chinese supply chain.
It's a massive deal. China dominates this space, and they've shown they're willing to use export controls as a weapon. Having a proven U.S.-based source for heavy rare earths like dysprosium, it's a huge strategic advantage for the entire Western world.
Okay, so to pull all this off-ramping uranium, building the REE circuits, and developing this Australian project I've read about, that takes a serious amount of capital.
It takes a war chest, and they had one. Before this latest move, they were sitting on nearly $1 billion in working capital. Very strong balance sheet.
So why the big capital raise? The $700 million convertible notes offering? If you have $1 billion, why raise another $700 million?
Because this isn't just a small expansion. This is a transformation. And the market saw it as a really strategic move, mostly because of how it was structured.
Okay, what was so special about the structure?
Well, first, the interest rate was incredibly low, just 0.75%. That tells you institutions have immense confidence in the long-term story. They're willing to lend for almost nothing just to get a piece of the potential upside.
And this money is specifically for growth.
Right. It's non-recourse growth capital, earmarked for two things: the Phase 2 REE expansion at White Mesa and developing their heavy mineral sands project in Australia, which is called the Donald Project.
Okay, let's pause there because I saw they use something called capped call transactions. Can you explain what that means for an investor?
Sure. Think of it like buying insurance against dilution. Normally, a convertible note might convert into shares at a price that's, say, 20% above the current stock price.
Which would create new shares and dilute existing shareholders.
Right. But by using these capped calls, they effectively raise the conversion price all the way up to $30.70 per share.
So the bondholders don't get to convert to stock unless the share price goes way, way up.
Exactly. It's a huge signal of institutional alignment. Those investors are betting the stock will go well above $30. It shows you the smart money sees major upside from here.
And with all that capital, what's the ultimate goal? What kind of company are they trying to become?
The target is staggering. The plan is to generate up to $986 million in annual revenue from all three streams: uranium, REEs, and the mineral sands, once everything is fully ramped up.
Almost $1 billion. That's a different company entirely.
It's an order of magnitude shift.
Yeah.
And that's the vision that's really driving the current valuation.
Which brings us to the bear case. We have to talk about the risks. And the first one anyone brings up is that valuation.
And they're right to bring it up. It is expensive on any current metric. You're looking at a price-to-sales ratio of something like 46.7. That's pricing in a lot of future success.
So if there are any delays, any execution problems, the stock is very vulnerable.
Extremely vulnerable. And that ties right into the second risk: profitability. Right now they're losing money, negative net income, negative EBITDA margins.
Because they're in this heavy investment phase, spending now to hopefully earn a lot more later.
Correct. But they have to execute perfectly on these huge, complex projects to get there. And we should also mention the insider activity has been a little mixed. There have been some notable sales by executives recently.
Which always makes investors nervous. Is it just taking profits after a big run-up, or do they see challenges ahead?
It's a fair question. It just adds another layer of skepticism that you have to watch.
Yeah.
At the end of the day, it all comes down to execution.
Okay, so looking forward, what are the immediate catalysts we should be watching over the next, say, 3 to 6 months?
Number one is the Q4 and full year 2025 earnings release. That should be late January or early February 2026. Everyone is going to be laser focused on the updated guidance for the REE ramp.
Any delays, there will be a problem.
A big problem. Then on the technical front, after dysprosium, the next one to watch for is terbium oxide.
Another rare earth.
Yeah, another critical heavy rare earth for magnets. They're supposed to have qualification samples for terbium ready in early 2026. If they get that qualified too, it proves they can handle multiple high-value rare earths.
And what about institutional money flow?
Keep an eye on the ETF rebalancing in December. That could drive a lot of volume. And then the big 13F filings in January will show us which major funds we're buying in at the end of this year. You know, at the end of the day, Energy Fuels is making this colossal bet. They're putting $700 million, plus all their uranium cash flow, into this transformation. They want to be one of the only true critical mineral champions in the West, providing everything from nuclear fuel to the rare earths for the energy transition.
It's a huge vision.
It is. So the question for you, as you look at this, is pretty simple. Can their operational execution actually overcome the very high valuation risk that's already baked into the stock price?
A powerful question to think about. Thank you for tuning in to the Investing Talk podcast. If you enjoyed this analysis, please hit that subscribe button to catch our next look at the markets.